Hello everyone, welcome to our YouTube channel, and today I'll be talking about Elliott wave theory. So this would be an introduction video on Elliott wave theory. So this is named after the person Elliott, and he proposed that market cycles resulted from investors' reactions to outside influences, and he found that the upward and downward swings of the mass psychology always showed up in the same repetitive patterns, which were then divided into further patterns. Patterns he termed it as waves. Now, what it actually means is it's not easy to predict the direction of the market. In short, and it's known as Elliott wave theory. So this theory is somewhat based on the Dow Jones theory, Dow theory, and which moves in waves. And because of the fractal nature of the markets, Elliott was able to break down and analyze them in some details. So fractals are mathematical structures which on ever smaller scale infinitely repeat themselves. So Elliott discovered stock trading patterns were structured in the same way. So he began to look at these repeating patterns, which could be used as a predictive indicators of future market moves. So market predictions based on wave patterns was designed by Elliott, and he made detailed stock market predictions based on unique characteristics. So an impulsive wave which goes with the main trend always shows five waves in its pattern. On a smaller scale, within each of the impulsive waves, five waves can again be found. So in this in this smaller pattern, the same pattern repeats itself. So these ever smaller patterns are labeled as different wave degrees in the Elliott wave principle. So in the financial market, we know that every action creates an equal and opposite reaction. Now, as a price movement up or down must be followed by a contrary movement. Now, price action is divided into trends and corrections or sideways movements. Now, trend always shows the main direction of prices, while corrections move against the trend. Now, Elliott labeled these as impulsive and corrective waves. So, uh, so the theory is interpreted as follows: every action is followed by a reaction. Second would be five waves move in the direction of the main trend, followed by three corrective waves, a 5 to 3 move. So a 5 to 3 move completes a particular cycle, and this 5 to 3 move then becomes two subdivisions of the next higher 5 to 3 wave. The underlying 5 to 3 pattern remains constant, though the time span of each may vary. Now, this is a typical chart how it looks like: 5 to 3 pattern here, and labeled as 1 2 3 4 5 and ABC. So again, this wave actually gained popularity sometime in the late in 1970s, and this this is usually known as when there is by especially at this point of time in Indian markets, Indian stock markets, in July, August. This is predominantly, many people are saying that this is an Elliott wave theory, and it's not so easy to make money with this theory because this theory itself looks slightly complicated. But again, that's an overview about this particular theory. Hope you enjoyed this informative video. If you have any questions or clarifications, feel free to ask, and I'll be happy to clarify. Thank you, and I'll see you again on my next video.